West Texas Intermediate crude oil is taking a bit of a breather this morning as China reimposes some lockdown conditions in Shanghai. But even as crude retreats somewhat from 13-week highs and multi-year generally level highs, experts believe the price of oil will continue to rise. Earlier this week, Morgan Stanley predicted oil prices could reach up to $150 per barrel. Goldman Sachs has also recently upped its forecast on where crude is going, West Texas Intermediate crude going in the near term. Joining us to talk more about it is Rafi Tahmazian, Director and Senior Portfolio Manager at Canoe Financial. Rafi, thanks a lot for joining us. One thing specialists like you have been expecting is for the generalist investor to, I guess, wake up to the supply-demand realities facing the oil market as a commodity and the investing environment for oil and gas securities. Again, just to refresh viewers' memories, Goldman Sachs, Morgan Stanley, and Bank of America all upping their forecasts on crude oil prices just this week alone. Is that what we're seeing happening when these Wall Street giants cast a spotlight on rising oil prices?
Yeah, I mean, they're already raising levels to yet another level again. This is not hard math to work out. We've been calling for higher prices for quite some time. I think all of us were originally worried about the supply impact as prices rose. Well, a year and a half into a very aggressive rise in prices from multiple reasons, and we have not seen any supply response. So clearly the impact of the investor reaction to producers not to produce more production and the negative attitude around the sector given the climate scenario has really destroyed this supply side and making the math real simple to understand. Oil prices are going a lot higher. I would not by any stretch try to think about the price of oil in the short term, meaning what happens over the next month or two. The next month or two are going to be extremely volatile. The next 6 months are going to be volatile. Frankly, we think the foreseeable future is. But the general trend will be demand is violently out of control. It's a disease almost in the world, both the developed and undeveloped. And supply side is going to take massive amounts of capital that we don't see on the horizon at all right now. So generally speaking, prices to the right going up, and we would take advantage of any weakness through China slowdowns or, we used to get those Delta or Omicron variants that would come and create a short-term cycle down, or maybe an SPR release, those kinds of things. Those are all temporary things that are not really doing anything to the fundamentals to fix the supply-demand imbalance.
You use the phrase demand violently out of control. Explain what you mean there.
Yeah, I mean, look, we look at it in two very distinct ways. It's developed world versus undeveloped world. And in an environment where we're deglobalizing now again after a 20-year globalization experiment, this is not going to be the time where people should be thinking we're going to be going back to what was happening pre-COVID. We're going to be in a very unproductive environment. We're going to be in a world that is kind of east-west again. So two different product environments, inflationary environment, costs are going up. We think that that's going to elevate the geopolitical risk. And so the demand for our oil that we need to operate is going to be dependent on where we get it. And where we get it right now, unfortunately, in the developed world is for the most part, or half of it is in the undeveloped world. We produce 30 million barrels in the OECD world. We consume 45 million of it. So we have a very high dependency on the non-OECD world or the OPEC nations and more of those dissident nations for our energy. That is elevating our security risk. So while all these banks are talking about increasing oil prices, I think we should already be moving on to the situation where we're going to have scarcity of power, substantially increased prices in it, and we're going to see elevated amount of security risk. And a good example of that, frankly, is already happening in our backyard with Ukraine and Russia. Russia used their oil, the Europe's oil dependency on them as a weapon of war, really is what that boils down to. And they would not have been able to invade Ukraine without that weapon. So that's what is going to develop more and more. And the answer to alleviate that is to start to spend massive amounts of capital on infrastructure and supply in the developed world. That puts Canada in an amazingly good position when you think of it that way.
The share prices of many, if not all, Canadian energy, oil and gas producers are trading at their highest prices in a long time, in short. Some of them at record highs, others at the highest prices in many, many years. Obviously, I suspect you think there's still value in shares, for instance, like CNQ, perhaps the most high profile of them all. It's up something like 180% over the past 52 weeks.
It's crazy. I know, Paul. And I was on your show the day of the meltdown in March of 20, just shaking my head saying there's several 100% returns in front of us here. And it felt awkward to talk like that. And that development happened because the sector completely washed out and capitulated. The rise that we've seen in these stocks to this point is only really getting them back to a normal bottom. And now they are sitting valued at a very, very reasonable bottom now. This is not a position to think that they're overbought in, because the commodity prices are so healthy right now. And remember, the downside to the commodity price is not really a fear for us. This is about the environment right now. The opportunities are far outweighing the negatives. And so you're constructive about the oil price. But we would think that we would rather see actually the demand subside and maybe an environment where we see a recession develop, even a soft one, or even a large one. Look, we need to find a way to quell this demand. We can't have prices rising and rising and rising. And right now, the world is set up that way. And we would rather a more controlled, based, stable production level. Then you'll see producers start to increase their production if they see a stable price, and we'll start to see a more normalized environment. But right now, frankly, we're so constructive on the oil price that the upside is maybe a significant increase in the valuation of these things, as opposed to people who are trying to say, oh, the contrarian view would be that these are going down. Their valuations just don't dictate that.
Okay, thank you very much. I misspoke, by the way, on the gain, the 52-week gain on CNQ. It's about 85%, not 185%. I think I may have been thinking of Meg Energy. But nonetheless, Rafi Tahmazian, thank you a great deal for this conversation. He's Director and Senior Portfolio Manager at Canoe Financial. He joined us from Calgary.